Welcome to TaxLawGH and welcome to our video where we still talk about the rules around deductible input VAT. Still very crucial when it comes to understanding the basic principles and concepts of VAT. As a quick recap, remember we've spoken about the 6-month rule where we've said that if you do not have in possession a VAT invoice that is less than 6 months old, you may not be able to get an input deduction. So it means invoices that are older than 6 months dated will not be available for an input VAT deduction. Also, we said that input VAT that related to motor vehicle expenses or motor vehicle spare parts will not be available for an input VAT deduction. We also said expenses relating to entertainment and hotel will not be available for deduction unless for both scenarios you're in the business of dealing in motor vehicle and motor vehicle spare parts, or you're in the business of dealing in entertainment. We also said that subscriptions will generally not be allowable as an input deduction for VAT purposes. Now let's talk about other specific rules that you need to meet if you are to get an input VAT deduction. Remember, we said also that you need to be in possession of a tax invoice issued by the Commissioner General to you as a taxable person. So if you don't have a tax invoice that is less than 6 months old, then all things being equal, you not get an input deduction. But the law, in its leniency, gives room. And here we are saying that where a taxable person does not have that tax invoice, the original one issued to you by the Commissioner General, we are saying that the Commissioner General may allow you an input deduction based on your satisfaction of some extra conditions. What are these conditions? We are saying the first one is if that taxable person took all reasonable steps to acquire the tax invoice. Second, failure to acquire that invoice was not their fault. And third, the amount of deductible input tax they are claiming is correct. Then the Commissioner General has the right, the discretion to allow you to get a deduction. So if you're able to prove that even though you don't have the original invoice, you have taken all steps to acquire the invoice, and your failure to acquire the invoice wasn't your fault, and the amount you are claiming is correct, then he will go ahead to give you the deduction. The reason why the law is saying you should have taken all reasonable steps to acquire the invoice is because if you recall, we said in one of our past videos on VAT that where a taxable person realizes within a period of 30 days that they have lost the original invoice, they are required to write to the supplier to request for that person to provide them with a duplicate of the invoice, and that person was obliged to respond to them. So if the law has given you the room to write to a supplier to request for a missing invoice, then the law is expecting you to exhaust that avenue before you come and give the excuse that you do not have an invoice. That is why you could not provide the original. So remember that before you can get a deduction without having the original VAT invoice, you should have taken all reasonable steps to acquire the invoice. The failure to acquire the invoice was not your fault, and the amount you are claiming is correct. This is very important. We're also saying here that a newly registered taxable person is allowed to claim an input deduction in the first tax period, in their first month when they registered for VAT, for two categories of items. The first is for goods that they acquired either by way of supply or import within 4 months before the effective date of registration and on hand before the effective date of registration or on the effective date of registration. What does this mean? If you bought goods or you imported goods for the purpose of using them in your business and you bought them 4 months before your effective date of registration and you had the goods on hand when you started business, you are allowed to deduct the input tax in your first month after registration. What does this mean? So let's say you got a number of goods or a number of inputs that you want to use to run your business. You bought them 4 months before your effective date of registration. The law is saying that in your first month, when you are filing a VAT return after registering, you are allowed to deduct the input VAT on these goods, provided that you acquire them within a period of 4 months before your effective date of registration. We are saying that apart from these goods, when it comes to capital goods, these will be more like your tangible assets, your fixed assets, right? So for capital goods that you acquire within 6 months before the effective date of registration and you have them on hand on the effective date of registration, you can deduct the input for them. So let's say capital goods, let's say you bought assets or machines to run your business, and these machines you bought them within a period of 6 months before your effective date of registration, and you had them on hand, you had them in the business on the day you started your operations, then as long as they are within a period of 6 months before your effective date of registration as a taxable person for VAT purposes, then you can deduct the input in your first month after commencing operations as a taxable person for VAT purposes. So remember, general goods is 4 months before effective date of registration. Capital goods is 6 months before the effective date of registration. Key thing to remember. What happens where you want to deduct input tax, but it relates to a mixture of taxable supplies and exempt supplies? All we've spoken about so far is on the assumption that you have either entirely taxable or entirely exempt. And if you recall, we said that if you have exempt supplies, you cannot get an input tax deduction for exempt supplies. We said for taxable supplies, there are a number of conditions which I've gone over. So if you remember the 6 month rule, which says your invoices do not have to be older than 6 months if you want an input deduction. If you remember entertainment, hotel, if you remember motor vehicle spare parts, all of those things are for when you have things that are actually taxable, but because of those rules, you can't deduct them. This is where you have a mixture of taxable and exempt supplies. What are the rules when it comes to determine what you can deduct? We are saying that where a taxable person makes both taxable and exempt supplies, and they want to deduct their inputs, then there are certain things to be considered. We are saying that if you make both taxable and exempt supplies, you may deduct the input tax on your taxable purchases and taxable imports, which can be directly attributed only to the taxable supplies made. So if you can make an allocation and say that the taxable supplies I made, the proportion of inputs that I can relate or link to them, these are the ones that are taxable, these are the ones that are non-exempt, then you can take those ones as a deduction. So if you can do a mapping and say that for all the taxable supplies I made in terms of my output VAT, if I can link and do a matching that out of my mixture of exempt and taxable inputs, this proportion of inputs or taxable input relates to my taxable output, then you can deduct that portion. We are saying that where the person makes a mixture of both taxable and exempt supplies, but they are unable to directly attribute input tax to the taxable portion, the exempt portion, then they may deduct the input tax based on a certain ratio, based on a certain formula. So remember that where you can directly allocate which portion of your inputs which are taxable relates to your taxable outputs or taxable supplies, then do that allocation and deduct. Where you are unable to directly attribute the input tax to your taxable and exempt supplies as a mixture, then the law is saying there's a ratio that you need to comply with. We are saying that for the purpose, the ratio is A times B over C, and this can be found in the 5th schedule to the VAT Act. So A times B all over C, where A is the total amount of input tax for the period. So don't forget, we are trying to apportion something. So A is total amount of input tax for the period that is not directly attributable to taxable or exempt supplies. So your input tax that you are unable to tell which portion relates to taxable supplies or exempt supplies will be A. What is B? B will obviously be the total amount of taxable supplies you made during the period. So all the supplies you made, which portion was taxable? Then C, if you can guess, will be the total of all supplies you made, including the taxable and the exempt ones. So what we are doing here essentially is we are taking the B, which is the taxable supplies you made, over C, which is all your supplies. So it will be proportion or percentage of taxable supplies out of total supplies multiplied by the portion of input tax that you are unable to directly attribute to taxable or exempt. So let's say you incurred 1,000 cedis. You can't allocate it to either taxable or supplies, but it's your input tax. Then we are saying that if we do the B over C, and let's say you do 50% taxable out of your total, then obviously it's only 50% that will go. So this is not a formula to remember per se. Just know that we are trying to split the A, which is the non-attributable input tax. That's how people call it. They call it NAIT, non-attributable input tax, that you're trying to apportion, times B, which is your taxable supplies made all over C, which will be your total supplies, including the taxable and exempt ones in simple sense. We're saying that if the ratio of taxable supplies to total supplies for the period is less than 5%, then you are not entitled to any input tax at all. Remember this. If you do this math and then the ratio of your taxable supplies, your B, out of your C, the total is less than 5%, you are saying that, you know what, you are not supplying enough taxable supplies to even deserve an input tax deduction. So we are denying you the whole amount. So remember, there's a 5% threshold. If your B over C gives you a figure that is less than 5%, then we deny the whole amount. You don't even get even 1 CD as an input tax deduction. However, on the other hand, if the ratio of taxable supplies to total taxable and total supplies, if the ratio of taxable supplies to total supplies, if your B over C exceeds 95%, then you may deduct the whole input tax as allowable input deduction. What does this mean? If you do your B over C, you get 96%, you get 97%, you get anything even up to 99%, then we are saying that C, you have incurred enough to qualify for the whole amount being deductible. So remember, it's 595 rule. If it's 5% or less, if it's less than 5%, you are denied an entire deduction. You don't even get anything. If it's more than 95%, we are like, you know what, let's ignore the 5% and give this person 100% deduction. So remember the 595 rule. There are a number of rules to remember in this topic: 6-month rule, motor vehicle rule, motor vehicle spare parts rule, entertainment and hotel rule, class and subscription rule, and having an original tax invoice rule. Then let's add the 595 rule to it as well. And these are things you need to remember. Very, very important principles, very important rules to have in mind. So what else must you recollect? We are saying that despite any other provision, in the case of a bank or other financial institution making both exempt and taxable supplies, the amount of the input tax deduction is limited to the amount of input tax deduction which are directly attributable to making taxable supplies. So same principle. We are, even for banks and financial institutions, who, don't forget, when we're doing the principle on exempt supplies, you said financial services were exempt. So even for banks, if they have other services that are taxable, then the portion that I can deduct is only the portion that is relating to making taxable supplies. Very, very important principle to remember. Now we've looked at deductible input tax. The principle in summary is that you take a person's output tax and you deduct their input tax. The output tax, all things being equal, will be that person's tax on their output. So on their sales, on their services rendered. If they are a standard rated person, then they will charge VAT at the rate of 12.5%. They will charge a national health insurance levy at the rate of 2.5%, and they will charge a Ghana Education Trust Fund levy at the rate of 2.5%. Then we are saying that when it comes to their deductible input tax, the only one they can deduct is the 12.5% VAT. The 2.5% NHIL and 2.5% GET Fund levy are non-deductible. Rule number 1. Rule number 2 is that even the 12.5% that is deductible as input VAT, there are certain rules and conditions which we've just gone over. Next thing to remember is that persons under the VAT flat rate scheme, the wholesalers and retailers of tangible goods who charge 3%, are not allowed an input deduction. Remember these. Let's talk about refunds or credits. Where the amount of input tax, which is deductible, exceeds the output, what happens? What we've looked at is, I've already mentioned this, if the output exceeds input, all things being equal, you pay the difference to the GRA. What happens when your input, the deductible one, take note, exceeds your output? The general rule is that the excess will be credited by the Commissioner General to the taxable person. So you'll be given a credit which you can carry forward into future tax periods to offset any future payable you may have on a going forward basis. There's another scenario where the Commissioner General will give you a refund, but you must meet certain conditions. We are saying that in the case where the portion of the excess, which excess? Your excess input over your output, or the case where your input exceeds your output, we are saying that where the portion of the excess is attributable to you making exports or exporting items, right? They are saying the Commissioner General may refund that excess credit to that person on condition that person's exports exceed 25% of their total supplies within the period, and the export proceeds have been repatriated by that importer's bank into the taxable person's dealer bank account in Ghana. What are we saying here? If you want a refund, then the portion of the excess you are trying to seek a refund for must relate to export, number one. And second rule or second condition to meet is that export should comprise at least 25% of the total supply. So you mean you should, at a minimum, be exporting 25% of your supplies outside Ghana. Minimum. So if you are someone who deals wholly in Ghana, all things being equal at this point, forget about a refund. We'll see other conditions, but general rule is that you must be exporting at least 25%. You need to meet another condition. After exporting, the money you make must be repatriated into your bank account in Ghana. So the money shouldn't stay outside Ghana. If you meet these criteria, then we are saying a person may now apply for a refund. What I just mentioned, you can write a Commissioner General for a refund where the credit remains outstanding for a continuous period of 3 months. You can see they are giving you so many hurdles to jump over when it comes to paying you back money, right? And it only makes sense. They need to ensure they don't pay out too much, but they collect as much as possible. So after you've met these conditions, you are exporter number one, your exports exceed 25%, the export proceeds have been repatriated into your bank account in Ghana, then you may now apply for a refund. But even then, that credit must have remained outstanding for a continuous period of 3 months or more, right? So that's the general principle, except the Commissioner General decides to do an audit which will have different criteria. But remember, the credit must be outstanding for a continuous period of 3 months or more. What happens then? We are saying that apart from this, when it comes to adjustments, which I said will fall under the advanced video, so don't worry about that for now. You can make adjustments, plus or minuses, just know that for now. We're saying that under the case of adjustment, where the amount of tax paid by a person was in excess of the amount they were properly subject to tax under this VAT Act, then the amount of the excess will be treated in the same manner, which we'll talk about similarly. Also, where a person has actually overpaid taxes, right, then the person may apply to a Commissioner General for a refund. This is where you have paid more than you should have paid. They are saying you can write a Commissioner General for a refund, right, with documentary proof of the payment of excess amount. Then the Commissioner General, when he is satisfied that you have made an application based on what I just said, you've overpaid, you've written to him, he shall do something. He shall first apply the amount of the excess against the liability of you, the person applying, for any tax, any levy, any interest or penalty that he administers. So let's say he finds out that, he actually owes you money, you've overpaid. Before he gives you a cash payment, he'll go and check, do you owe corporate income taxes? Do you owe withholding taxes? Do you owe, have you not satisfied your withholding tax on your employees for the period? He will check to ensure that you don't owe him any other tax before he makes a payment. So too bad if you owe him another tax type, he will deduct it from there, and if there's money left, he will pay you. If there's actually something for you to pay him, he actually come and ask you to pay him. So before he pays you money, he checks to see if you owe him any other tax type apart from VAT. Then he will take the money from there. He will use it to offset the balance before he pays you if you still have money outstanding. Then we are saying he will repay any amount remaining to you within 30 days of being satisfied that you overpay tax. So remember that the rule in VAT is that if you overpay tax and he checks and he realizes that, this person has actually overpaid tax, he will first check to see, do you owe any other tax types? He will check with all the tax offices, everyone, to see, does this person have a clean record? In fact, he'll come and audit your operations. After auditing, try to find any way to see if you owe any tax, and if you owe tax, he will offset it before he pays you any amount. So remember, within 30 days when he's satisfied. Then we are saying also that a claim for a refund is required to be made within 6 months after the date on which the excess arose. So you have a period of 6 months to apply for the refund. Then the Commissioner General will serve a notice to you if you are claiming a refund in writing, and he will tell you his decision in respect of the claim, whether he's agreed or he disagrees with you. Whatever be the case, he will let you know what his mind is in writing. Then remember we said where you cancel your registration, there are certain rules that apply. If you remember, we said that you are deemed to have what? Realized all your goods on hand, but if you don't remember, it's fine. We are saying where the registration of a taxable person is cancelled and that person has excess credits that were not recovered, then the excess credits may be treated in the same manner, which is what? Apply for a refund. So let's say you've cancelled the registration. Then after cancelling, you still have credits. It only makes sense that he pays your money back to you. Why? Because you've cancelled registration, you will no longer be a taxable person. But there must be a condition. You must apply for a refund by submitting a refund claim form, together with what? All relevant documents that prove that indeed you are entitled to a refund. When the Commissioner General rejects your claim for refund, he has a right to recover any amount in accordance with the VAT Act if he paid you any amount in error and wrongly. So let's say he paid you money you did not deserve, he has a right to recover all amounts from you. In addition to the refund claim form you are required to submit, he has a right to ask you to add any other proof he wants. If you want your financial statements, you ask you. If you want invoices related to a particular transaction, he has a right to ask you for anything he wants because he's going to pay you money. He must double check to make sure you deserve that payment before he pays even 1 CD to you. Then, except as otherwise provided, like I said, a credit is supposed to be carried forward to the next tax period. So the default is that if you have input tax exceeding output tax, forget about refund for now. You carry forward to the next tax period. That is the default. You carry forward to the next tax period to see, so that if the next month comes and you now have an output exceeding input, instead of you going to pay the GRA money, you use your credit you brought forward from the previous month to offset that output, and then you pay any difference, if any. If not, you keep carrying forward until you exhaust everything. Remember, the refund is for number one, exporters, and then also for persons who have cancelled registration or who have actually overpaid tax within the circumstances I just mentioned. Then, if you make a claim for a refund that you are not entitled to, you actually go and refund. You are, and they actually find you, they actually catch you. You are liable to a penalty of double the original amount plus interest. So don't try this. If you apply for a refund you are not entitled to, and they find out how much you are applying for, they'll multiply it times 2 and collect that money from you, and they'll even charge you interest. Remember, this principle is very important. Then, when must the Commissioner General pay the refund? Where you are entitled to a refund, Commissioner General will pay you within 30 days after receiving an application. This is what the law says, but in practice, I have not seen 30 days. It takes a very long time because they will have to do an audit to confirm, but at least let's stick to what the law says. You're writing an exam, right? So within 30 days, the law says the Commissioner General will pay you your refund on condition that you have submitted all previous returns and that you have paid all taxes, all penalties, all interest. You don't owe him anything, then he will pay the amount within 30 days. Where you've not fulfilled the conditions above, which is in point A above, which means submitting all previous returns, the Commissioner General will reject your claim for refund entirely. If he checks and you've not submitted your previous returns, he will just reject your claim. He won't even look twice at your application. Where he checks and then you have not fully paid your taxes, penalties, and interest you may be owing him, then he will offset any entitlement for a refund against the amount due. So he will check, like I said earlier, if you owe him any other tax, any other interest, any other penalty, he will deduct all those amounts you owe him before he pays you any difference. If he still owes you within a period of 30 days. But remember, if you don't file your returns, he's going to reject your application outright because you don't have any business with him. You are not being compliant as a taxpayer. Then, this is an interesting provision the law provides for, but I'm yet to see it happen in practice. The law says that where the Commissioner General fails to pay a refund, right, within the period, which is the 30 days, then the Commissioner General is required to pay you, the taxpayer, an additional amount as interest at the prevailing Bank of Ghana discount rate, which will typically be the monetary policy rate, plus 1/4 of that rate each day, commencing on the day after the period in which he was required to pay. So they are saying that he was supposed to pay you back in 30 days. If he fails, he's required to pay you interest plus the amount he owes you at the BOG discount rate, plus 1/4 of that rate for each day. But to be honest, I haven't seen him pay anyone interest. In Ghana, we say you're actually lucky to get a refund. So this is the law, but in practice, just know that you are not too likely to get a Commissioner General pay you interest for a refund delay. Just know this. So now that we've spoken about refunds, let's talk about submission of your tax returns and the date of payment of tax. Generally, you are required to file a tax return for each month, whether or not you have tax payable. There's a rule. VAT returns, whether you have no transactions, as long as you are registered, you must file a return every single month. So remember, you must file a tax return for each month. Then, like I've spoken about this so many times if you've been listening, when we introduce the fiscal electronic devices, there will be mechanisms or measures or policies, procedures around how to file returns. When it comes, we'll cross. When we get there, we'll cross. We are saying that also the tax return shall be in a form and manner recommended by the Commissioner General. So there's a VAT form. I'll show you how one of these look like in a subsequent video. So just stay around. So now, because of the way VAT is administered in Ghana, you need to file two sets of returns, one for VAT and another one, a second one, which will contain the National Health Insurance Levy and the Get Fund Levy on one return. So because if you're a standard rated person, you file a VAT return and you file an NHIL and Get Fund return, so two returns. There's a separate return for those who are under the flat rate scheme, who will file a VAT flat rate return. Then there's a separate return for imported services VAT. So remember, these are all returns you have to file. And if you have been appointed as a withholding VAT agent, you have another return to file. But I'll have a different timeline. We'll cover that in the video on withholding VAT. So remember, you must file VAT for every month. And we are saying here, when must it be filed? VAT returns must be filed on or before the last working day of the month, immediately following the month to which the return relates. Keyword here, whether or not tax is payable. So you can say, oh, but I did no transaction during the month. Yes, we filed nil VAT return. So just write 0000 on every box in the return and submit. But you must submit a return. If you don't submit a VAT return, you are liable to a penalty of 500 Ghana cedis instant and 10 Ghana cedis for each day that you have not filed a return. So remember, once you are registered for VAT, you have an ongoing liability or an ongoing obligation every single month. When must it be filed? Last working day of the month. So let's say for January, you have to file your January VAT return by the last working day of February. Remember, it is not 30th, it is not 31st, it is not 28th or 29th if it's February in a leap year. It is the last working day. So check. If the last calendar day of the month falls on a weekend, you have to count forward and then file on the last working day. The law is very specific. We are saying you have to pay the tax on the same day. So you file return and pay tax on the same day. They are not different. And we've reiterated the penalty here. When you fail to submit, there's a penalty. Instant 500 cedis and 10 cedis for each day the return remains outstanding. And if you watch our videos on tax administration, you realize that this penalty of 500 cedis instant and 10 cedis for each day the return remains outstanding applies to all our tax returns in Ghana except for communication service tax, which I'll tell you what it is because it's very punitive, right? So when we get there, just know that this will apply for a lot of your returns. Then we are saying, despite this, a VAT withholding agent will need to file their returns on the 15th day of the month, following the month to which the return relates. So remember I mentioned that apart from the standard rated VAT return, there's another one for the NHL and Get Fund, which you need to file if you're a standard rated person. I said the flat rate guys have to file a separate flat rate return. All these returns are due on the last working day of the month. However, for withholding VAT returns must be filed on the 15th day of the next month, not last working day. So just know this. But don't worry, we'll have a separate video on withholding VAT where we'll talk about this into a lot more detail. So these are things you need to remember. These are concepts you need to remember. These are very, very important things that you need to have in mind. So at this point, let's pause here. We have covered the fundamental principles, the fundamental concepts of VAT. This should give you a fair idea of what VAT is about from end to end. Our next video on VAT will be on exam questions on the basics, but we'll post videos on the advanced concepts. We'll go into the VAT legislative instrument. This for people who really want quite advanced level of knowledge in VH. Remember I mentioned that for the motor vehicle and motor vehicle spare parts that you cannot deduct input for, and for the entertainment and the hotel expenses, the VAT legislative instrument has given details as to what can you deduct and what can you not deduct. So remember I said for motor vehicles, it's not a blanket rule. Even though motor vehicles are generally not deductible, there are some types of motor vehicles that you can deduct as import tax, even though you're not in the business of dealing in motor vehicles. So those advanced concepts are for those who are interested in really learning VAT to a very, very advanced level. So let's stop here, let's pause here. If you love this video, as always, don't forget to smash the like button. And don't forget to share this video within your network. And if you've not subscribed, don't forget to hit the subscribe button as well. I'll catch you in our next video.